Hey, what's up, everybody? Welcome back to Investing Sucks. So in this video, we're going to be doing a deeper analysis into RBI. So I did a video on these people last week, and it was more of a preliminary analysis on them. And that's really what a lot of the videos I do on this channel. And since I started this Your Company, My Analysis series, it's been a lot of preliminary analyses. So in this video, I actually want to go deeper into the company and actually show you guys, if I do decide to go deeper into a company, what sort of things would I personally look at given whatever company we're looking at. So now, fair warning for those of you guys watching this video is probably going to be a bit more technical than most of the videos I do because I am going to go pretty in depth in certain topics of the company that I think are of particular importance. So I know a lot of you guys who watch my videos are interested in the more deeper type stuff, but if you came to YouTube because you want to be entertained or watch something casual, then this is probably not going to be the video for you. So feel free to turn the video off. I promise you I won't get offended. But if you do choose to stick around, I think you will find this video pretty interesting. So without further ado, let's actually dive into it. Okay, so I've gone here to their MD&A section for the year 2021, and they actually did some pretty good work here in breaking down some information for the various segments going back a few years. So we can look here at the Tim Hortons segment. And if you guys recall from the last video I did, I noted how there's kind of an even split between the revenue they generate just from what they refer to as sales, which would just be kind of their corporate owned stores, as well as these supply chain operations that are specific to the Tim Hortons segment. And it was kind of an even split between those. And really the reason for the even split is pretty much all their restaurants, or the vast majority of their restaurants, are actually franchised. So it's a pretty asset light business model, to be honest, because they don't really own a lot of stores. But if you look at the Tim Hortons segment, you'll see that their sales, which again represents the supply chain operations, which are specific to Tim Hortons, which make up a big chunk of the Tim Hortons revenue here, and then also the corporate owned stores. The franchise revenue for Tim Hortons is only just about 900 million. And then advertising revenue is really just going to correlate pretty much exactly what the advertising expenses will be. The advertising expenses are a bit higher this year, but if you look in the previous years, it's pretty much going to be bang on. You can see here 232 million in costs and then 232 million in advertising revenue. So it's like that for the other ones as well. If we go to the Burger King segment, you can see the sales from the corporate owned stores are very, very small. The vast majority is going to be for the franchise restaurants they have, which is really just dependent on the sales. So they have this metric they report called system-wide sales. So that's really the total sales at their actual restaurants. But of course, since they only receive revenue from the franchisors, then they would get about 5 to 6%, I believe, is as a percentage of those sales. And then kind of a similar thing with Popeyes. They don't have Firehouse Subs, their new acquisition here yet, but you can see the vast majority comes from franchise revenue with this advertising revenue here. But really, that's just meant to compensate for the advertising expense. As you can see, again, pretty much bang on in the previous years. So that was the main takeaway from that is the vast majority of the restaurants are franchised. And that was something I didn't quite pick up on at first because they do have these supply chain operations for Tim Hortons specifically, which I tried to do a bit more research and find out what those actually were. And I couldn't really find a whole lot of information on it. It really just seems like they're selling restaurant equipment to perhaps other of their restaurants. That's about all I could find on that. And then they talk about their system-wide revenue growth here. So essentially what I did is I'm going to go into Excel next. But what I did was I took this information that they've reported here. So they talk about the restaurant growth as well, which is a pretty big thing for this company, as we're going to see. That's a big driver of the investment performance is how many new restaurants can they actually open, because as we'll see, some of their restaurants, the same store sales aren't growing a whole lot, if at all. So I took a bunch of this data and I put it into Excel, and then I'll show you what key insights I was able to drive from it. Okay, so here I've gone into Excel, and at the top here I have the system-wide sales, but I only went back 3 years for that. It's really not that important of a metric because the actual franchise revenue they generate is going to be directly correlated with this because they earn it as a percentage. What I instead want to focus on is the restaurant count. So I went back about 6 years and took data on the amount of restaurants they have. Now, Popeyes, you can see they don't have 2016 data because I believe it was around this time period, 2016, 2017, it was acquired. And then Firehouse Subs, I was able to find data on going back to 2019. So if you look at the growth in new Tim Hortons stores, it's only about 2.5%. And whereas compared to Popeyes, it's over 5%. So again, that kind of continues the theme that we learned last time, which is Popeyes is by far the best performing restaurant in terms of growth. Only if you're looking at total sales, Popeye is actually very small. But in terms of growth, so growth in store revenue and then also new stores opening, Popeyes is definitely number one. And then Burger King was opening up a few more stores. So they still are able to open more stores. So that's a good sign, and we'll keep that in mind for later. So then they also had revenue by restaurant here. So this is data that I believe I showed in the last video I did. Quite simply, it's just showing that the actual revenue that they're generating broken down by each restaurant. So in 2021, their total revenue would have been this amount plus the amount of revenue that was earned by Firehouse after their acquisition, which their acquisition was late in the year. I believe it was December 15th of 2021. So it didn't contribute much to that. And this revenue would consist of all the franchising revenue, the corporate-owned stores revenue, and the advertising revenue. But then they also provided data on operating income by restaurant. So if we look at Tim Hortons here, we can see it's been pretty stagnant, and it did actually have a decline in 2020, which pretty much all of them had a decline except for Popeyes. Popeyes actually, their operating income actually went up, but still it's pretty small in comparison to Tim Hortons and Burger King. So you've seen a bit of a shift in the past few years. Tim Hortons used to be their number one in terms of income, but as of 2021, that's shifted, and now it's Burger King, and Popeyes still growing very, very fast. And then they don't really have that much data on this for Firehouse subs. So we're going to have to kind of guess what that'll be. So then I went further and looked at the operating margin on a restaurant basis to see how this changed. And with Tim Hortons, you can see a very notable decline here. So you can see it's 36%, 36%, 34, 34, and then it dropped. In these years, it dropped here. So let's go back to the MD&A that we were looking at before and see if we can figure out why Tim Hortons specifically, their operating margin dropped. So if we go back to the MD&A section here for Tim Hortons, we can see this was the year 2021 when they had about 29% operating margin. Here was about 30%, and this was about 36%. And there's no real one reason why their margins went down that much. It was kind of a combination of a lot of things. And really what happened was their sales declined going into 2020 and recovered in 2021, were basically stagnant from the 2019 year, whereas their costs kind of increased. We can see cost of sales did go down in 2020, but kind of went up to a level that was higher, much higher than it was in 2019, whilst all these other fixed costs here, like their franchise, property costs, and all the depreciation, amortization, that all kind of stayed where it was at. And their advertising expenses, so in 2021, 277 million, they weren't able to offset that with their advertising revenues. So it was probably a combination of a lot of things there. And personally, I don't think this is indicative of any sort of trend. Maybe the company could face a sort of labor shortage and they would have to increase the wages they paid their employees. Specifically, the corporate employees, not the employees that work for the franchisees themselves, because it's really just a labor shortage in general. It's not just a labor shortage at restaurants itself. It's permeating throughout the entire economy. So maybe there could be some further margin compression, but personally, I would say that 30% kind of seems reasonable to expect for them going into the near future. Okay, so if we go back to our Excel file here and go back to the operating margin section, we can see for Popeyes, really no change in the operating margin. It's been pretty much consistent for the past 5 years. But if we look at Burger King, we can see a pretty drastic change. So 2016, it was 67% operating margin. So that's very high. And then 72% in 2017. But then it's kind of fallen down and kind of normalized at that 56% range. So let's take a look at what happened in these years to see why this happened and whether or not we think that it could be something that continues into the future. Okay, so I've actually gone to the 2019 MD&A and we're looking at the Burger King segment here again, because this does a great job at splitting out that data so we can decipher what caused that change. And we can see pretty clearly it was because of the segment SG&A. It had a pretty sharp increase going into 2018, because we can see here sales actually went up quite a bit. They went from 1.2 billion to 1.65 billion, but the segment income only went up by about 25 million there. So a big reason for that was because of this sharp increase in the segment SG&A, which is probably because of the advertising expense. There was probably more advertising that they had to allocate to Burger King because maybe they thought the brand was starting to lose some steam in the market, or they had some new promotions, some, new products they wanted to advertise, but it's kind of stayed at that level going forward. For example, if we go back here to the 2021 MD&A section, we go to the Burger King, we can see now they've kind of split it out. So before they had SG&A, now they have the advertising expenses split out, and the advertising expenses have been pretty consistent, not really much change there. So I would say what we're seeing with the operating margins for Burger King being 56%, that's probably going to continue going into the future just because this hasn't changed a lot. Maybe they need to up their advertising expenses a lot. Again, maybe they have to advertise a new product, but that's not really something that you can accurately predict as an investor at this time, because that's just going to depend on whatever management decides, and you really can't decipher that definitively at this point. Okay, so at this point, we've done a pretty good job at breaking down the various trends we're seeing at each individual restaurant for the ones we have data on, because we don't really have data for Firehouse subs. So what I tried to do here is take the revenue on a per restaurant basis. So this is all in thousands. This isn't in millions. So this is how much revenue each restaurant is generating. So, and we can look at kind of the growth in this. So all I did to find this was just take, for example, the amount of restaurants they have and the amount of revenue they generated, and just calculate that number for all the ones that we have data on. So we can see a pretty clear trend with Tim Hortons. It actually has declined by a 0.6% compounded from 2016 to 2021. Now it was actually increasing. We can see here 654,000, 664, 679. Then it stagnated, and then 2020 happened and it kind of declined, but it did recover a bit. So maybe you have some reason to think that this could grow into the future. However, just with this trend we're seeing, for the purposes of what I'm trying to do, I'm going to just assume that it stays at the level of 2021 indefinitely. So that helps build some upside, because maybe they're able to grow it more. That just leaves more room for upside. But it's a more conservative assumption. So Popeyes here, their revenue per restaurant is growing pretty rapidly. So at a 10% compounded rate through these 5 years that we have since they acquired them. So again, that builds on the theme of Popeyes being the strongest performing restaurant. And then we have Burger King, which Burger King is actually growing. So 3% compounded growth in revenue per store. So the good news with RBI is, with the exception of Tim Hortons here, all of their restaurants are growing organically. They're not just growing from opening new restaurants, which, as we saw here, they are opening new restaurants, but the revenue per restaurant is actually growing as well. So that is a good sign, and that's something that we can build on a bit more. So then I have this tab here called future profitability is what I've called it. So what I'm trying to do here is, as accurately as I can, try and project what the operating margins will be for the companies going forward, and also what the sales will be if we assume that the trends we just found out continue into the future, right? So these would be trends in restaurant growth. So I'm assuming what we saw in the past is pretty much going to be consistent into the future, maybe slightly more conservative. So Tim Hortons, they opened 2.5% new stores per year. That's pretty much in line with what it's been historically. 5% for Popeyes, 3% for Burger King. And then I just estimated Firehouse subs to be 5%, because it is a comparatively smaller restaurant. And they did mention that they had 3x'd the amount of restaurants that they had open over a period of about 8 or 10 years. So 5% is conservative for that. And then the revenue per restaurant, right? So this is what we just looked at. So again, like I said, I'm going to assume that Tim Hortons stays constant. So it stays at this number, which it was in 2021 into the future, which I think is a conservative assumption, because with the exception of the lockdown years, they were actually growing this number. So I'm okay with that assumption. It's more conservative, which I always try and build some conservatism in there. And then Popeyes, let's assume through 2028 that they continue to grow at 10% a year, which again, that's saying quite a bit. That's pretty optimistic, but I do think it's a trend that's reasonable to expect. just because the Popeyes brand has been catching a lot of steam lately, and really the popularity is growing quite a lot. And they have proven that they can continue to come out with new products that people like, and people seem to go there quite a lot. So I think that's reasonable to assume. Again, some people may disagree with me there. And then pretty much keeping in line with the historical trend for Burger King as well. So I tried to make this as objective as I could, just by taking historical growth rates and projecting them into the future. So then we were able to actually calculate pretty accurately, I would say, what the company's total revenue will be for all of these years here. So then what I've done in my DCF model is I've engineered their revenue so that it meets those numbers exactly here. I've taken that data and just plugged it in. So then the next step would be to look at the operating margins. So I'm basically going to assume that the operating margins are going to pretty much stay at what they've been at in the past. So 30% for Tim Hortons, 56% for Burger King, 40% for Popeyes. Now, I couldn't really find data on what it would be for Firehouse, but I basically just took, you could see here, an average of these three to get 42%. So that's somewhere in the middle. And Firehouse is such a small part of the business currently that really, if whether we put 40% or 50% or 60%, it's really not going to change things that much. So then if we take these sales that we've projected here for each company, and then try and calculate what the operating margins would be based on those sales, then here's what our operating margins would be for the next about 7 years. So it does go up slightly. And I think the reason it goes up slightly is because we have Tim Hortons, which is the lowest operating margin, essentially stagnating, whereas you have Popeyes with a 40% and Burger King with a 56%, opening up more stores and growing their sales per store at a higher rate, right? Because Tim Hortons were only assuming 2.5% store growth and 0% growth in same-store sales. Popeyes were assuming 10% growth in same-store sales, in addition to 5% growth in stores itself, and then 3% for Burger King. So when you do the math there, this is what the operating margins come out to be. So I think that's a pretty exacting measure there. It gives us a pretty reasonable estimate of what things could be in the future. So here's the DCF model that I did in the last video. So if you kind of want to get a deeper understanding of what I did in this DCF model, then I recommend you check out the last video I did on them, because it'll make things a lot easier to understand. But nonetheless, I did make some changes. So I increased the share buyback rate because I did notice that the company was permitted to repurchase up to 31 million shares for the next 2 years. Now, they do have share-based compensation, which will naturally cause some dilution in the amount of shares they have. So essentially, I engineered this rate so that they reduce the amount of shares outstanding by about 30 million. So maybe they'll repurchase more shares in the years 2024 to 2027, but that could be offset by issuing shares for their share repurchase plan. So to me, that seems like a pretty baseline assumption to have. And to me, I'm okay with having that in there. So taxes paid, they do have a very low tax rate. The perpetual growth rate, I kept it at 1%, and their cost of capital only about 6.5%, because if we go back to the cost of capital, they are funded by quite a lot of debt versus equity. For example, we go here, their total debt on their balance sheet was about 13.2 billion, whereas their market cap was about 18 billion. So about 42% of their capital structure is debt. And because their debt has a generally low interest rate, then their cost of capital will naturally be lower. So then we can go through all the math here. We get this stream of future free cash flows. We discount them to the present to get our enterprise value. And then we add the cash. So I put 1.75 billion in cash by 2028, about 16 billion in debt. So we reduce that to get to the equity value. And I essentially assumed that the debt will grow at a similar rate to the restaurants that are being opened. And I'll do a bit more, show you what I mean with that in a bit. But essentially what we get here is a 13.75 estimated annual return, which is an okay return. It's not a stellar return. Me personally, I'm looking for more in the 15% estimated annual return before I make an investment. So With that in mind, my kind of buy price, I guess, if we put 55 in there, we pretty much get to 15%. So 55 US dollars would personally be my buy price for this company, because my goal is to at least estimate that I'm earning a 15% annual return, because anything lower than that, and I'm not really that interested in it. So that's pretty much where I'd be comfortable sitting at. Okay, so now we've covered really the valuation, which is kind of the cash flow slash operating performance side of the business. But let's also just quickly look at the balance sheet side, which is more of the financial stability slash liquidity aspect of the business. Because as we noted in the past video, this company has a very significant amount of debt on their balance sheet. And something I think we can expect in the coming months is rising interest rates. It's already started to happen, and it's become pretty clear that inflation is not transitory, and interest rates are going to need to increase in order to contain inflation. And even the central banks here in Canada or in the US have come out and said that they're willing to risk a recession in order to contain inflation. So I think we kind of have to do some sort of a sensitivity analysis to understand what is the interest rate risk. Now, luckily, they did break this down in their MD&A section here, where they said a hypothetical 1% increase in LIBOR, which is currently what they use as their prime rate, which in the year 2023, I believe the LIBOR rate is being discontinued and replaced with this SOFR rate, which I believe they're kind of similar. So a 1% increase would increase their interest expense by about 25 million. So that's pretty useful information. So 25 million, that's not exactly something that's going to be threatening to them. And they do manage their interest rate risk by doing interest rate swaps. So that's a regular course of their business operations. I'm not going to get too in depth on how that works, because that's a whole other topic. But if we take a look at their balance sheet, they have over $1 billion in cash on hand. And if we look at their cash flow from operations, they're generating currently about 1.7 billion in cash from operations. So I would say their liquidity is fine, right? Because if interest rates say increase 4%, right, then their interest cost goes up by 100 million, but they're generating much more than that in the cash from operations, and their cash from operations we're projecting to grow, right? Now, really what is the key driver of this high debt balance is the acquisitions that they made. Because if we look at their debt, so if we go to the long-term debt, it really jumps in the years of the acquisition. So here goes from 8.5 billion right here to just under 12 billion. That was the Popeyes acquisition. And then it kind of stays flat at that area. It goes up a bit slightly in this year. And then in 2021, this is when they made the Firehouse acquisition. But that was a pretty small acquisition. That was only about $1 billion. Popeyes wasn't that big either, about 1.6 billion. This would have been the merger here. But really, if we take a look at their balance sheet, the big item on the debt side is obviously the long-term debt, as we've looked at. But the big item on the asset side is the intangibles. So this is kind of what they're recognizing as their brands. So all the brands of the 4 restaurants they own, that's what these intangibles are, right? So it's not really a hard asset, because if in the event that the business starts to fail, then those intangible assets are essentially worthless, right? Because if the business is failing, the business is the brands, right? That's the whole part of the business. That's what they do. So these assets will be worthless in a situation where the business itself is failing. So the balance sheet isn't great. You kind of have to recognize that. And you are, by investing in this company, making a bet on the brands at least not declining from where they are. I mean, ideally, you would like to see them grow and become more strong, same store sales increase, they open more stores, but you wouldn't expect them to decline, because if they do start to decline and you start to notice a downtrend in same store sales, they can't open as many stores, that would spell trouble. And that, for me as an investor in this company, would be okay. If I'm seeing that, it's time to get out, right? Because there's just too much risk at that point. So anyways, guys, that pretty much does it for me for this video. So thank you so much for sticking around and listening to this more deeper type of analysis. If you did enjoy this type of video, going actually deeper into one specific company and not just looking at an individual company in a more preliminary and surface level area, then please let me know, and let me know if you'd like to see more of these types of videos, because I definitely would enjoy making these videos more. But thank you so much for sticking around and listening, and I will see you in the next video.